The biggest debt markets in the world are starting to flash warning signs while stocks remain incredibly high. And with rate cuts now being taken off the table for possibly even up to May, it seems unlikely that markets can sustain. But obviously the AI wave continues to be good this earnings season, with Palantir doing well and Nvidia absolutely rocket shipping up to almost $700. So what happens now that we almost reached the pinnacle, another 1,000 level for the S&P 500? Well, the results might surprise you, and in today's video, we'll take a look at all of that and what tends to happen around such a big zone. The biggest hedge in the world, the US dollar, is moving forward. US yields are reaching a critical zone, and one of the biggest stocks in the world is starting to suffer. That and more coming up in today's show as we cover stocks, commodities, and cryptos together. Well, welcome back everyone to the Daily Show where we talk about markets around the world. My name's Tom. We've been running this show for over 3+ years together, and we've got some massive data, macro, and of course, key levels coming your way today. Nvidia was up, LLY was joining it, and really the rest was down. If it wasn't for a few of the stocks that were really big in market cap, you'd have to say the day was pretty bad. Meta down 3% overall, giving up some of its 20% gains, and Tesla and McDonald's down pretty hard. McDonald's suffering from, of course, lost revenue due to conflicts around the world. Let's talk about seasonality snag. It turns out that we've got some issues here with February. It's the third worst month of the year from the last 30 years of data. But you might be thinking, well, when does it get bad? Well, traditionally, it gets bad around the middle of the month. We shared this info over on our X profile, so if you're interested in following and checking those out, you can do so in the links in the description down below. Let's now talk S&P 500 after relative strength index has cycled from basically oversold to overbought. Now, usually we don't talk too much about this, but we will bring in a couple of indicators later to show the divergences at the highs that we have right now. And the reason we're bringing it up is because when we see this with those extra stats, we do tend to lead into coin flippy style scenarios. And it comes through with a couple of stats that we've been discussing. S&P after 1% daily gain, which we saw last week, with more declining stocks than advancing stocks. Again, coin flippy, not necessarily the best news for the next couple of weeks ahead. And then, of course, we had the FOMC last week as well, which led us into this stat, which is when the FOMC comes out and we have a negative 1.5% day, then that tends to go into a bit of a coin flip. So basically, the stats are starting to suggest maybe a chop or some kind of weakness coming through on the markets. Here's another one that says when we have the S&P 500 gaining over 20% in the last 14 weeks, we close to a new all-time high, although we only have a few data points for this. What tends to happen? And again, it gets a little bit choppy with some amazing returns afterwards. So of course, if we do see a dip, what's the expectation? There'll probably be a rip just around the corner. Let's talk about why a dip could happen. Of course, this is an interesting one here. According to Goldman Sachs, the prime book is starting to get a little bit hot here for info technology stocks, and they're basically all in on the stock market itself. Now, this is a bit of an issue because, of course, it means that we're overbought. And we've already talked about that from the idea of also CTAs being absolutely super heavy, that we always almost needing to change the chart in terms of how much they've been buying up. We also know that if CTAs switch, we need to be paying attention because that has led into often sells in the market that can last maybe even a month or two. So something we'll be looking at. S&P right now, though, not enough to really go off. We've seen a little bit of weakness from the CTAs, but of course, we will update you if we get any changes here with a quick video. So, of course, make sure to subscribe if you're interested in finding out more about that. Another thing you're going to be wanting to look at as well is the VIX. It seems like around 14.5 is a massive point for the VIX moving forward and could be worthy of an alert on your charts, because if 14.5 is broken, it seems like the next levels are 16, 17, 18, every dollar after basically, and 19. So that's where we see the market moving to. So that 14.5 to 16 could be a pretty big move on the VIX, and certainly something that could really get that volatility spiking again, because we haven't seen it in a little while now since the massive return of the market last October. Let's talk about target rate probabilities. As we can see, percentages are moving pretty heavily. We did have odds at around 60% last week in terms of Friday of a May cut. Now we're only at 46%. Now, that's a huge switch in the curve. So basically, the market is saying, you know what, we're going higher for longer, but the S&P is not caring right now because it's earnings season and AI is still looking pretty good on the charts. We can also see even the skew is getting weird. Goldman Sachs is showing here that we're really facing a huge amount of SPX volatility skew at a 20-year high, while put volatility skew is at 20-year lows. So a huge difference in terms of where we've got the skew right now. And while this is not necessarily statistically super important to give us edge, it is a very interesting fact. Let's now talk about tech earnings and FOMC. We've already discussed the idea that as tech earnings come out, we can sometimes see a buy the rumor and sell the fact. Now you might think, well, Tom, it's already been big tech earnings. That was last week and we haven't sold off. It can take a little while, guys. And of course, it's not instantaneous. This was kind of the period that we saw these tech earnings. And of course, we find ourselves here with a little sell in the last 24 hours, not much. And the idea was that we had a 6-month rally and then we had some kind of distribution into lackluster. Now, the reason why you often see those February kind of middling results where you see selling after that is because earnings has happened. There's not much to be excited about in the market and the reality often does set in. And you'll notice that a lot of the time we do get these kind of seasonal sell-offs around earnings into those types of kind of concepts. What about direction of retail traders? What are we all doing right now? Well, of course, we're all really bullish. If you ask most people in a survey right now, as of the 31st of January, and I'm pretty sure right now as well, most people would say that they're bullish on the market with very little neutrality and super low bearishness across the board. Now, average bearishness is 31%. So to have so many bulls, to have so little bears has been historically rare. And it's generally led into complacency in the market, which can lead to sells. We've already talked about one of our favorite index features, which is the bullish percent index. And this is a big one because, of course, with the bullish percent index, as we posted over on our X account, we've got an overbought situation, but not just any overbought situation, one where it's gone from an 80 to the downside. Now, this can be a pre-warning of the market and it can take weeks for the market to actually sell off, but this is a fairly big deal. And of course, it's suggesting that the market might be looking at a bit of weakness around here as we approach this 5,000 level, which we'll discuss very soon. What about what happens during February? Here's the general seasonality so you guys can see it. And that's the history since 2003. But I'm more interested in what about sitting president and presidential years. So of course we have in this year an election year. And if the sitting president is running, we tend to actually see a sell-off at around the period of this week. And that's a very interesting one because of course, this is the statistics. That's what tends to happen. We've got that February into March sell-off. Remember, if we do get a sell-off, it should be relatively sustained. So mean reversion, maybe a little bit longer than you would expect, maybe a month, maybe like 3-4 weeks, that kind of thing realistically is what we're looking at. And it's pretty normal to get it. But if you are feeling, oh, wow, I'm bearish on the year, now you got to stop there a little bit because the stats are still very positive. We've had January barometers. You can see in election years, they tend to be incredibly positive. Overall, if we have a January up period, 100% of the time in similar scenarios, we've had a big gain by the end of the year, average of 15.6%. So we can't really be saying, oh, since 1950, things have been bad in these types of years. No, in election years, they've been good if January was successful. And a lot of it has to also do with this stat here, which is what happens to the S&P 500 after a new all-time high after at least 252 days. So generally what that's saying is you're going into kind of a mini recession or major pullback in the market, and then you tend to see a huge turnaround. Now, this is just an interesting one. Take it with a little bit of a grain of salt because, of course, this time will be different to just a big vertical, you would think, but it is there. Another bullish stat for a longer-term investor that we've been talking about is the TOI 2-month from Wayne, and it's a 35-2 ratio. So basically, we're seeing 35 times out of 37, a bullish percentage, and by the end of the year. And also, we tend to only see very minimal bear years if we even get one when we had the setup from November to January like we did. Here's what Wayne has to say about February as well. You'll notice it's super choppy over the next couple of weeks, up, down, and all around in terms of statistical relevance. So very hard to pick there. But we will have updates from Wayne, I'm sure, after President's Day. So when that happens, we should be able to get some new stats that will tell us what happens next on average. Another one is good from Jason here that shows that we have some interesting stuff going on when it comes to Chinese stocks. Now, today, according to Jason, was the 6th straight day with 3 more declining than advancing stocks in the Shanghai Composite. That's actually never happened in 27 years of trading history on that particular market. But we have seen 5 days before, and in every single period, you might be surprised to hear that it's positive over the next period of time. Now, the reason why that is because we're probably in capitulation on the Shanghai Composite and Chinese stocks. And you can see here that when we enter into these types of capitulation levels, which has only been a few history points, we tend to have positive returns over the next months into the next 12 months. And this is what we already expected when we looked at the Hang Seng the other day and we saw it really freaking out. We thought, okay, 2 weeks later, there's a possibility we've got a new low across these markets. But in general, it's a positive attitude moving forward, even though everything looks so bleak and terrible. And it does seem like we're leading into a very interesting time here for Chinese stocks. And we've been talking about for 2 weeks for an obvious reason, because we could be at those serious lows right now. Let's now talk about what's going on when it comes to options, because you're all very interested, I'm sure, in knowing why and how these markets are holding up the ways they are. So 5,000 is a super gravity point. This is a huge call resistance and it's a massive level. We also know that around the 49 to 49.10 is a huge little put level on certain 0 DTEs. So I think this is going to be a very interesting zone for markets. And if they break through this technical level, which we'll look at later on today's video, that's going to be a big deal for all of us as traders and investors. In terms of earnings moving forward, we still have some big ones. Enphase copying it a bit over the last 24 hours. That'll be an interesting one to see how it returns. Chipotle, a stock that just keeps going up. Will it finally suffer? But some interesting ones this week will be Disney, PayPal, and I think Baba as well. So let's see how bad it really is. Will Baba actually be a catalyst that's positive or negative for the stock market in China? I think that's one that we will be watching quite closely. In terms of expected moves, here are the options expected moves. As we thought, Palantir was going to be a big one. I think it was actually a plus minus 14 coming into the announcement. And I think it went, plus 18 or something after hours. So it was certainly a huge move. Do remember the risks of earnings are in the options volatility. And you can see it here always. So make sure to subscribe. We always share that one across the board. Let's talk dark pool activity now, though, because there were some interesting things going on with the SPY. And it's been a while since we've got some nice trades on the SPY. But you might notice just around this 495-ish level, we've seen a lot of sellers. Well, what we can suspect is probably sellers. Now, maybe it's too early to tell and we'll need to see more price action. But as the market comes up to this price, we seem to be getting a lot of transactions going through. And it's not just there. It's in a few places at the moment. We're also getting it in the SQQQ, which is a popular ticker code. And you can see there's huge amounts of transactions down here. And they would profit, obviously, you would think, from going up. Now, you could argue, well, look, someone was here. They might have been taking profit here. But I would say there's more transactions down here than there was here. So it's more than likely that the SQQQ is getting some big trades on it. And maybe someone is thinking there's going to be some volatility just around the corner. We've also got Treasury bonds coming down to a very important level. We've seen this defended before. Treasuries had a great rise last week off 93, 94. They're back down to that level again. They need to defend here because if they don't and the market goes underneath, it could get kind of nasty for Treasuries as yields will be breaking out across the board. And we'll talk about that in just a moment. Let's now move over to the options world. Lots of options activity. Of course, it's earnings season. We always expect that. 41 million options, 58% calls, so a ton of calls. Retail traders making up 26% of the single legs. And there wasn't really, I guess, any standout other than this one here, which was Energy Transfer, just because it had 38 times. But Super Microcomputer got a 4.19 90-day average. Huge move there. And we started to see, I would say, still fairly even options between the calls and the puts on things like the SPY, with some slightly higher than average moves on a couple of those. Still a very interesting time. Rotation-wise, semiconductors were lifted just realistically because of one stock, which is Nvidia. But we still had some defensives. Healthcare trying to break to new highs as we've seen some big moves on healthcare. We will do our special in our next video on healthcare because there's a couple of things there I want to talk about. And it was kind of like a mixed day. A lot of declines, actually, when you think about it. Way more sectors down than up. And this is because semis and Nvidia is holding this market at this point. Over the last 5 days, semis is now number one, but we have XLV and XLP just underneath it, two defensives. And we have KRE, which is regional banks, down 10%. So that's going to eventually affect the market. I mean, they are targeting it and shorting it, but you would think it is an issue. What about central bank liquidity? Both were down. Central banks around the world, central banks in the US. Obviously, we were seeing weakness across both of those. It's not leading into the market yet, but not a great sign to see the recovery of central bank liquidity starting to drop off. We've also got yields. Now, I'll be watching both the US 10-year and US 2-year to see what happens next. We've got yields bouncing back to the 4.2. Take a look at the US 2-year. The US 2-year, we've got an alert set here at about 4.5. And if we get through that zone, you could quite easily see the US 2-year going back up to 4.7. And you've got to think that's going to have an effect on stocks. It could be this straw that breaks the current level, even with all of the AI stocks doing so well. Consumer discretionary versus staples, which is, of course, what we call the American consumer, holding its own. If this breaks underneath to a new low and gets another red candle, it will have broken the 20 moving average properly. And I think that could lead into further selling, which obviously is not going to be great for the markets. What about home builders? They were down early. Some home builders not doing so well, and then they rallied up. So no weakness necessarily on this particular chart. And of course, you should always look at transportation's average as well, which we'll put on the chart here, which has been, I guess you would say, hovering in the middle ground. It's not going up, nor is it going down. When we take a look at the bonds themselves, adjusting for everything that's gone on with yields, I wouldn't say they've freaked out. So contrary to maybe the news articles at the front, I think that the bonds market is not necessarily freaking at this point, but it's certainly not going up in lockstep with the markets. Now, if we see the bonds start to move down, don't worry, we'll be the first to alert you, and we'll be talking about this all together. So, of course, we'll be on top of that when it does occur. If we move over to the US dollar, now this is an interesting one because I'm sure a few people are analyzing this and they're saying, look, we've got a left shoulder, a head, a right shoulder, therefore an inverse head and shoulders kind of pattern, and that's going to push to a new high for the dollar. People are freaking out about this. I think that the next logical conclusion is probably going to be around 105.80, and this is a pretty big daily close for it. So, of course, we thought about 103.80 to 104 for a long time, and it finally hit it. Then we were looking to see whether there's weakness around here or strength. Now, the daily would suggest that maybe we're actually going into a little bit of strength right now, and we're moving towards that next level. Again, if yields break out and the dollar moves, I think we all know it's going to get pretty fierce there for about a day or so as we move to the next level. What about copper? Looks pretty bad. Weekly rejection wick, obviously going down. Copper breaks a new low somewhere around 375-ish. I'll just get the price for you, 373. That will be a pretty big level, and this is a big rejection wick. Now, it's worthy of having an alert above here still, just in case copper does do that. But on this chart right now, copper is weakening, showing us that there are some signs under the hood of cracking. And we're also seeing that in oil as well when you think about it. Gold, nowhere land. I would say unless gold breaks above 2060 or 2003, it's in the middle of nowhere land. So not much to report on gold at this stage. US oil continues to drop. So we got here, it trading around 72.5 a barrel. Now, this is a pretty bad level for it because if it can't hold here, which kind of needs to hold right around this zone that it's trading at. So this could be where day traders try to look for buys on oil. Then it's going to have a big problem because, of course, it shorted off 78, which is not a bad level for it to short off. We weakened off. We're back at these levels. If we get underneath here, then we're going to start pressuring, you would think, the 67s and the 66.50s. And if we get underneath that level, then we've really got problems. Because remember, if oil is dropping, even in the face of crisis around the world, it's showing you something about the underlying economy. The market's saying, you know what, I don't think it's too healthy. That's what it's kind of telling us there. What about Tesla? Well, Tesla also not a too healthy stock at the moment, dropping a lot during the day off all of these allegations and stuff. And then we saw a rally back up. Now, this is interesting because as we've mentioned before, when Tesla gapped down, it needs to find a rally over the next 30 days. Now, we're about a week into that so far. So what we're seeing is the normal type of trade that I would expect. Of course, this level being a key zone, being around that 165-ish zone of previous support. But what we're looking for really is to break through 194. So 194, 195, I think if it does that, if we find this type of wick and then we breach this level, things for Tesla are looking much better on the stock. Right now, bit close to TAL. It's not a bad bounce up, but I could still see it going down through this level. So yeah, Tesla certainly looking at some big reactions moving forward. And I think this is going to provide an interesting trade relatively soon. Semiconductors, we had an island reversal we reported on about a week ago. Weakness in a lot of semis, but Nvidia is saving the day on this one right now. Depending on which semi ETF you're using, you'll see differing results. But yeah, an interesting one. Island reversal down, and then this big couple of sessions up thanks to Nvidia. And speaking of Nvidia, $700. In post-market, it's up another $1. Now, this is absolutely squeezing people that are short. And I would say retail shorters have tried to get in, probably shorted heavy around the 600 target, and then maybe even 660, which is that 12-month target. Now, I had a look at the metrics on Nvidia. It's trading at 1 standard deviation above its 5-year forward PEs, and that's not good. Now, at one point, funnily enough, at this pullback in time, it was actually trading relatively cheap. Now it's starting to trade very heavy. And what this means is that you can't stop it, but what you might notice is that these candles are not normal. So these candles are very, very large. And you might say, well, Tom, none of them are normal. This is normal. This is not normal. These are starting to get big. And this is what you often see with a blow off. Now, we haven't got it yet. Of course, I would not go against this trend, nor would I even get out if I was in profit on this trade. Because if I was rallying this scale out so far, I'd just be like, yep, keep going. Let's go, let's go, let's go. The trend will be your friend in these types of ones. Calling the top is very difficult. In fact, almost statistically impossible. But when it gets bad, it's going to get bad. And what that means is that we are detaching from reality on this stock. We're moving too quickly, too fast. And that's going to be an issue. And of course, we're looking for those signs. And it's not the first time Nvidia has done this, but I want to just put this in perspective. Since breakout of 8th of January, Nvidia is up 38.34%, probably about 40 by the time it opens tomorrow. It was up 4.79% at the close and up another 1 post. So it is squeezing. It reminds me of 2021. And look, Nvidia has done this before where it's gone to these unrealistic moves, which would get very, very hyper. And then it either usually sits, kind of crashes and pulls back in time, or it just gets destroyed. So the problem with Nvidia is not going to be that it's a great stock. I love it. It's one of my best favorite investment stocks. But this price is, it's getting rich. And I think it'll be a great one and a perfect case study for the future when we watch it. And at this stage, I wouldn't fight it under any circumstances. Microsoft also my favorite stock, obviously, in the market. It's just floating around. But I just wanted to kind of point out that Nvidia is running incredibly hard right now. Do not fight that machine unless you have a brave heart. Let's talk about Hang Seng Index, and this is one that started to show some signs of recovery. To me, it's already done some little changes. I quite like what I see on this chart. The Shanghai Comp, the CQQQ, they're obviously, all of these are very much proceed with caution, but they are starting to look like positionals in some ways. And they'll be disconnected from the rest of the world markets as they've already faced, in some ways, almost a great recession, dropping between 70 and 90% per stock. What about the Aussie 200? It broke out the other day, gave a good weekly close. The Aussie 200 could benefit from obviously oil. It'll benefit from things like metals and minerals in general, and it will better from financials. So these are, and healthcare as well. So it does well from those types of markets. A little bit of breach out for Australians. Be very careful. It does look like it wants to go to new highs, but the rest of the world's going to have to bring it. And this is where we get the issues. Let's have a look at the US 2K. So the US 2K is coming into a bit of a problem because this is where it's bounced before. We know where the sellers are, and it doesn't look very good on the chart. So if I load up something like a weekly chart here, you're going to see that it looks kind of bad. You've got some rejections. You've obviously got a long leg doji, a weekly close down here could really expose that 1860 level. And in general, I would say the US 2K is not looking too healthy. Here's Russell 2K versus, of course, the S&P. Now, last year we crapped on about it quite a lot on this channel, and we were really bullish on the Russell. coming into the end of the year, November into December, really significant overperformance against the SPY. In fact, it was a 7% overperformance. But it's come back down to these key levels. And this is what we call a long-short strat. And of course, it's worthwhile considering whether Russell is cheap. Now, it's mostly regional banks. If you actually look underneath the hood and you put in, let's say, US 1000 growth, you'll find they're doing very, very well. But yeah, it's the regional banks that are hitting around the Russell right now, which is about 20+% of that market. What about the equal weighted market? What's it telling us? Of course, when we look at just the Mag 7 or the big AI stocks, they look okay. But what about this one? Now, if you know anything about technicals, you could very easily claim that this is some type of Wyckoff distribution or possibly accumulation that is appearing. We've got a series of just slightly higher highs. We've got obviously consolidation. And I think it's a chart that a few people are overlooking. So one to have on your charts, a breakout above, of course, will be quite significant. We'll set that. And we'll also set if it comes down here, so we can kind of get an idea of weakness coming in across the board. But equal weight market not showing the same signs as maybe the Qs or the SPY right now. Speaking of the Qs, we got an island reversal the other day to the downside. Then we got one to the upside, which I guess could cancel each other. And it's really just being led by a couple of stocks. So that's something to keep in mind. I think the SPY is the better one for us to look at. Before we go there, I just want to talk about divergence. So a lot of people are discussing this. Here's RSI, here's MACD. And what you might notice is that in both, whether you're putting it on a 4-hour, 2-hour daily chart, you're going to be generally seeing divergence. Now, you're always going to see those things when you've got a market the way it looks like in price action. I mean, MACD is literally moving averages. So basically speaking, you're always going to see some type of divergence. What we're looking at key level wise is we're looking for breaches below 4,900, which we know is also a big options level, or for a swing trader under 4,850. Because if we get under 4,900, we've really broken the straw, the first straw. The second straw is 4,850, which we've spoken about for a while, and that's a key level. And at this point, 5K is going to be an issue. And the reason why I say 5K is going to be an issue is I just want to quickly talk about this. Every 1,000 points, you tend to see the market come up to it, get close to it, and then usually sell off. Here's 4K for the first time. 39.67 sell, okay? That's the first time. Then we go over here to 3,000 for the first time, which happens actually at this point, which is 19. But you can see here, 29.40 sells off and actually gets close to it 2 times and then sells. Here's 3,000, just spikes it, sells off a bit. So that's interesting. Let's go over to 2,000. What happens at 2,000? So here's 2,000 for the first time, 2,000, 1983. So 1983 sells off, hits 2,000, barely spikes it, sells off. So you've got to be very, very careful around round numbers. And I think that's something to keep in the back of your mind. Another one from a CTA perspective is if you're looking at charts and you're thinking, okay, where are the CTAs actually going to be selling and reducing their position? Put a 20 moving average on. Generally speaking, if they move underneath this, I think they're going to start, relatively speaking, pulling back on their positions. And you'll notice that also holds around that 48.40, 48.50 zone. So yeah, the 20 moving average still means we're in an upward trend. If you're a bull in this market, couldn't blame you. I mean, let's face it, it's still been very bullish. But there's a lot of stuff underneath the hood. You got yields potentially breaking out. You got dollar literally breaking out. You've got so many things that are saying, you know what, the markets are just remaining bullish into earnings. Maybe it's going to be a buy the rumor, sell the fact still, as we've kind of talked about. Speaking of some other issues here, we've got Bitcoin, which is continuing to sell off from that level we've discussed, which has been just up here. So Bitcoin's managed again to weaken off the same zone. And you can see it just keeps testing that. This is the supply zone. And at this stage, the small time frame is down. The large time frame is still up until we break through, or when I say large, like 2 hour, 4 hour, is still up until we break through 41,500. So yeah, there's kind of like 2 trains of thought. If we do breach 44,000, that's going to be a huge level for the bulls. And I would expect relatively quick move up to 46 to 47. So some big zones coming up for Bitcoin, but at the moment that defense of 43.5 is very strong. So upcoming news, what do we have? RBA cash statement, probably not much happening there. It won't really affect the world too much. And then we've got unemployment claims this Thursday. That's the major news for the markets. It's really going to be allowed to be earnings. And do remember, a huge percentage of stocks, not market cap stocks, but percentage of stocks report this week. So it's arguably getting close to the end of earnings season already once we finish this week and maybe a little bit of next week. So that's why you often do see that buy the rumor, sell the fact that happens in February. Be careful out there, guys. We'll see what happens with the price action and we'll update you in less than 24 hours. Make sure to subscribe, smash that like button, and we'll see you all again very soon. Bye for now.